Hey everyone, in today's video we're diving deep into the Roth IRA. I'll define what it is, the pros and cons, how to use one, and compare a hypothetical situation of investing in a Roth IRA versus a non-IRA. At the end, I'll also cover some advanced IRA strategies to really help you get the most out of your retirement accounts. So without further ado, let's dive right in. What is a Roth IRA? IRA stands for Individual Retirement Account. This is a retirement account that you can open outside of work, such as your 401k plans. You can open a Roth IRA at most brokerage companies, such as a Fidelity or a Charles Schwab. The Roth part of the Roth IRA just means you're contributing after-tax dollars to this account. But here's the fun part. Once you contribute those after-tax dollars, your account's able to grow completely tax-free. That means that any potential gains through interest, dividends, or capital gains can be realized without paying any more taxes. You can think of your Roth IRA as a vehicle and your investments as the trips you go on in that vehicle. Some people make the mistake of contributing to a Roth IRA, but then forget to actually invest the money. This would be like buying a car and then leaving it in the driveway the whole time until it rusts and wears out. Generally speaking, the sooner you're able to start investing, the more you'll get in return. Let's illustrate this with an example. Let's say we have two people, Stacy and Bob. They both invest $10,000. Stacy invests her money in a Roth IRA, while Bob invests his money in a non-IRA brokerage account. With an 8% rate of return over 30 years, both of their investments grow to over $100,000. The difference between these two accounts is how much they pay in taxes. Assuming a 15% tax rate on his investment growth, Bob has to pay over $13,500 in taxes. Meanwhile, Stacy understood how to properly use her Roth IRA for tax-free growth. She gets to keep her entire $100,000, and she doesn't owe 1 penny in federal taxes. Compared to Bob, she saved over $13,500 in taxes. I'll take that extra money any day of the week. Now that was just one simplified example for illustrative purposes, but that same concept can be applied to any dollar amount. So let's get into the nitty-gritty of the Roth IRA. After you have opened your Roth IRA account, you're able to fund it with money known as contributions. These contributions must come from what the IRS refers to as earned income. Now, earned income just means money you received through work in the form of wages, salaries, tips, etc. It doesn't include what the IRS calls unearned income, such as interest, dividends, Social Security, or unemployment compensation. For example, in 2025, the contribution limits are $7,000 per year if you're under the age of 50 and $8,000 per year if you're 50 and older. This extra amount for those age 50 or older is known as the catch-up provision. Please note that these amounts could change each year. There's also another catch. The IRS only allows you to contribute to a Roth IRA if you're under certain income limits each year. In other words, if you make too much money, the IRS won't allow you to contribute to a Roth IRA. For single filers in 2025, you can make a full contribution if your modified adjusted gross income is under $150,000. Your contribution starts to get phased out between $150,000 and $165,000 of income, and then it becomes fully phased out at $165,000 or over. For married couples filing jointly, their income limit is $236,000 or less. It then starts to get partially phased out between $236,000 and $246,000, and then it gets fully phased out at income at or above $246,000. Now that we covered contributions to the account, let's move into investments within the account. Roth IRAs allow you to invest in different assets, such as stocks, bonds, ETFs, mutual funds, and more. Choosing what to invest in is ultimately up to you, but some popular options you may want to consider include index funds, such as VTI or VOO. You could do target date retirement funds, depending on your age and when you plan on retiring, or you could build your own portfolio of stocks and bonds. Let's move on to the withdrawal rules of the Roth IRA. This is actually where the Roth IRA shines and provides a lot of flexibility. You can withdraw your contributions at any time for any reason, tax and penalty free. That means if you contribute $7,000 into your account one year and later change your mind, you can withdraw that full $7,000 and not pay any taxes or penalties. I'd like to quickly distinguish between contributions and earnings. Like we covered earlier, Contributions are the funds you transfer into your account. Earnings are any growth that happens on top of those contributions. And those earnings could come in the form of interest, dividends, or price appreciation. In order to withdraw earnings, you must wait until you're age 59 and a half and until your Roth IRA account is at least 5 years old. If you withdraw the earnings early, you're subject to a 10% penalty plus ordinary income taxes. Now, there are exceptions that allow you to avoid this penalty on the early withdrawal of your earnings. These common exceptions include up to $10,000 for your first-time home purchase, up to $5,000 for birth or adoption expenses. You can also avoid the penalty with qualified educational expenses, death, disability, and terminal illnesses, and other criteria. So this account allows for some flexibility in that contributions can be withdrawn tax and penalty free. There's also ways to avoid paying the penalty on those early withdrawals of your earnings. Let's get right into the pros and cons of the Roth IRA. The pros include tax-free growth, tax-free withdrawals after the age of 59 and a half, and no required minimum distributions. The cons of the Roth IRA include there's no upfront tax deduction like you would get in a traditional IRA, there's income and contribution limits, and there's a potential early withdrawal penalty on earnings. Alright, if you've made it this far, let's dive a bit deeper into some advanced Roth IRA strategies. I'll briefly mention them here, but I'm also planning on doing future videos on these topics, so please subscribe so you don't miss out. The first of these advanced strategies is the Backdoor Roth IRA. For high-income earners who exceed the limits, this lets you contribute to a traditional IRA and then convert it to a Roth IRA. That allows you to realize all that same tax-free growth we mentioned earlier. The next advanced strategy is the Mega Backdoor Roth IRA. For those with a 401k plan at work that allow for after-tax contributions and in-plan Roth conversions, this allows you to stash over $70,000 per year into Roth accounts to again get all that tax-free growth. With all that in mind, let's make sure to avoid these costly Roth IRA mistakes, such as not investing the money, pulling your earnings out too early, not understanding Roth IRA contribution and income limits. Now these limits change each year, so please look them up as needed. So there we have it, an in-depth breakdown of the Roth IRA. Whether you're just starting out or looking to optimize your retirement strategy, the Roth IRA allows a lot of flexibility and potential tax savings. If you think this video is deserving, please contribute to that like button and subscribe for more financial tips. Also, if you have any questions about the Roth IRA, feel free to comment down below, and I may feature your question in a future video. Thanks for watching and take care.